In this video, we're going to record basic purchase transactions under a perpetual inventory system. Ham manufacturing uses a perpetual inventory system. The following activities occur during February. For each transaction, we're asked to prepare a journal entry and ensure our basic accounting equation remains in balance. On February 2nd, Ham purchased $30,000 worth of inventory on credit or on account. So we've got an asset going up, inventory, by $30,000, and on account, or credit, means we've got an increase in accounts payable as well. We're going to record the $30,000 increase in inventory with a debit to inventory, and of course we increase liabilities with credits, so we will credit accounts payable for $30,000. On February 10th, we're told that we receive an invoice for $500 for shipping charges for inventory purchased on February 2nd. In general, all costs incurred to get inventory in place and ready to sell, so that would be incoming freight, insurance, tariffs, taxes, etc., are included in the cost of inventory. The cost of shipping inventory to a customer is referred to as freight out, and it's treated as a selling expense. So when we receive this invoice for $500, we want to increase inventory by $500. And we've received a bill, an invoice, so we're going to increase accounts payable as well. The increase in inventory is a $500 debit to inventory, and the increase to accounts payable is a $500 credit to accounts payable. On February 12, Ham returns $4,000 of inventory to the vendor. So we will have a decrease in inventory for $4,000. And since we've returned the inventory, we no longer owe the vendor for it, so we'll have a decrease in accounts payable as well. We decrease liabilities with debits, so we will debit accounts payable for $4,000. And we decrease assets with credits, so we will credit inventory for $4,000. Then, on February 26th, we're told that Ham pays the vendor the $26,000 remaining balance. So we will have a decrease in cash of $26,000 and a decrease in accounts payable for $26,000. Again, we decrease liabilities or accounts payable with a debit to accounts payable for $20,000, and we will decrease the asset cash with a credit to cash of $26,000. We're now going to take a look at how we will record purchase discounts under a perpetual inventory system. We're told Walmart uses a perpetual inventory system, and the following activities occurred during February. And for each transaction, we're asked to prepare a journal entry and ensure the basic accounting equation remains in balance. On February 2nd, Walmart purchases $40,000 worth of inventory on credit with terms 210 net 30. That means we get a 2% discount if we pay within 10 days. Otherwise, the full or net amount due will be due within 30 days. So if we pay within 10 days, we get a 2% discount on whatever we pay. Whatever we don't pay is due within 30 days. So let's go ahead and take a look at that transaction on February 2nd. We've purchased $40,000 worth of inventory. So we've got an increase in assets of $40,000. And we've got an increase in accounts payable liabilities of $40,000. In terms of our journal entry, we increase assets with a debit to inventory, and we'll increase our liabilities with a credit to accounts payable. We're going to keep track of our accounts payable T account to show how we pay this down. So we have a $40,000 credit to accounts payable. On February 5th, Walmart returns $5,000 of defective inventory to the vendor. So what we're going to want to do is we need to take that inventory out of assets, so we've got to reduce assets and inventory by $5,000. And since we've returned it, we no longer owe the vendor $5,000, so we'll reduce accounts payable by $5,000. In terms of our journal entry, of course, we reduce accounts payable or liabilities with debits, a $5,000 debit to accounts payable. And we have a $40,000 balance from that first transaction. And now we're going to debit it by $5,000, bringing our ending balance for accounts payable, of course, to $35,000. The other half of our journal entry would have been the credit to inventory for $5,000. That should be inventory, not cash. On February 10th, Walmart pays for the inventory, taking advantage of all of its available discounts. Again, the purchase was made on February 2nd, and if we pay within 10 days, we get a 2% discount on any remaining balance that we owe. So we'll be entitled to a $700 discount. That's 2% times the $35,000 that we're paying early. So let's go ahead and take a look at the impact on our accounting equation. First, if we're paying for it all, we're going to want accounts payable to go down by that remaining $35,000 balance. But we're going to take a $700 discount. So we will only pay the vendor $34,300 in cash. Of course, debits don't equal credits. So what we're going to do is we're going to credit or reduce inventory by $700. We can think, really, we paid less for that inventory. All right, in terms of our journal entries, we record the reduction in liabilities with a debit to accounts payable. And let's take a look at our T account for accounts payable. Recall we began with a $40,000 balance at the time of the purchase. We returned $5,000 worth of merchandise, and now we've paid for the other $35,000, bringing the balance in accounts payable down to zero. In terms of our journal entry going on, we had a decrease in cash of $34,300, which we record with a debit to cash. And of course, we reduced inventory by $700, which is a credit to inventory. Now, if instead Walmart doesn't pay for the inventory until March 1st, it's not entitled to any discount. So we will owe the full $35,000. We'll have a decrease in assets of $35,000. We'll have that offset by an equal decrease in liabilities of $35,000. And of course, to record that decrease in liabilities, we debit accounts payable for $35,000, and we credit cash for $35,000. And again, we can see we've fully paid off our payable balance. Originally it was $4,000. We returned $5,000 worth of merchandise, and we made a payment of